Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Munna Bhai MBBS actor Arshad Varsi, his wife and former TV host Maria Goretti, and YouTube influencer Manish Mishra are in the news. But not for any new Bollywood project. They are among 31 people and entities barred by Sebi from trading in the securities market. The charge is that they were manipulating stock prices by making misleading claims on YouTube channels. While the phenomenon of pump and dump is not new, the number of financial influencers resorting to it has increased manyfold. So is Sebi finally addressing the elephant in the room? Bhaswar Kumar's report has the answer.
Maybe you think everyone's getting rich and getting there quick by cracking the stock market's code. So you go where everyone else does when they need knowledge these days. YouTube, Twitter, and Instagram. You find a video that claims it has a hot tip for you. Chances are, if you follow through on its advice, those who made the video may very well laugh all the way to the bank while you lose your hard-earned money. This phenomenon has become a major headache for the Securities and Exchange Board of India. Google too took down more than 7,500 YouTube channels in Q1 2023 as part of its investigation into coordinated influence operations. On March 2nd, Sebi barred several entities, including actor Arshad Varsi and his wife Maria Goretti, for their alleged role in a pump and dump scheme. Sebi found that gullible retail investors were manipulated into buying shares of two microcap firms by spreading fictitious information, such as an impending acquisition by the Adani Group by way of YouTube videos. Once these unsuspecting investors entered the script, the entities allegedly offloaded their holding at an inflated price, making unlawful gains. Financial influencers or finfluencers give financial advice on social media to ordinary investors on stocks, personal finance, and mutual funds. But they often don't have the required qualifications. At present, anyone doling out financial advice has to register as an investment advisor and comply with SEBI's regulations. Legally, finfluencers giving stock advice without an IA license can be held up by SEBI. Finfluencers may offer financial literacy, but their advice can often be risky due to paid partnerships and conflicts of interest. For example, brands rope in influencers to advertise their products or services. These include mutual fund investments, crypto platforms, and even IPOs, where influencers review the prospectus to attract retail attention. On the other hand, registered investment advisors are required to disclose any conflicts of interest. At present, there are no specific regulations from SEBI that address finfluencers. But the Advertising Standard Council of India prescribes that upfront and prominent disclosures must be made by influencers on advertisements, brand collaborations, paid partnerships, or sponsorships for all such posts on all platforms. However, the ASCI is a voluntary, self-regulatory organization. The combination of a large number of first-time market participants hungry for stock tips and the horde of influencers catering to them has put a strain on SEBI regulations that govern investment advice, investment research, and portfolio management. In November last year, Business Standard reported that SEBI was considering ways to bring finfluencers under the regulatory net without trampling on the freedom of expression. SEBI's intent here was to prevent mis-selling and stock price manipulation. Further details on the substance of these regulations are yet to be made public. So, what do experts think about SEBI's crackdown on finfluencers?
SEBI has become proactive in taking action against financial influencers, and I suppose it's sending the right signals. You can't stop it totally, as influencers will find loopholes. There will always be those bad apples, but action by SEBI will ensure that it's not rampant.
While I do not know what is the factual position what SEBI is doing, but it really appears that SEBI has decided to take head on the YouTube influencers or social media influencers who are misguiding investors. Whatever SEBI may do will not be enough, because every day new YouTubers will come, there will be new accounts and all the things.
Also, what more can Sebi do as far as finfluencers are concerned, and what challenges is it likely to face in bringing them under the regulatory net?
SEBI's job in such cases is that of policing. And just like the police intelligence has confidential informants across, SEBI too should plan, unless they already have that in place. You ask any decently connected veteran participant in the market, and they would be able to point out a couple of stocks where nefarious activities are suspected to be happening. There is so much chatter in the social media. At times, looking at the movement in certain stocks, one can take a calculated guess that something is amiss. So it's better to get advance information than to hunt for culprits after the damage is done.
Currently, there is already a law which is an investment advisory regulation under which no person can have provide any advice to an investor without having a license under that. Now, to bring the influencers under the ambit, SEBI will have to look at that. What should be is there a separate license in addition to the investment advisory licenses? The person who is advising, what is his qualification? Is he qualified to advise? What are his personal interests? A disclosure norm might be put in place. So it is going to be very tough.
The number of demat accounts in India rose to 110 million in January 2023, a surge of 31% on a yearly basis. Finfluencers could influence the investment decisions made by many of these new market entrants, making it all the more important to bring them under the regulatory net. International developments could also provide some direction perhaps. For example, last year, the Australian securities market regulator announced imprisonment and financial penalties for breaches by social media influencers.
But there is also a bright side to it. Financial influencers like Pranjal Kamra and Rachna Ranade have earned a good reputation among millions of investors who turn to them for financial tips. Their numbers grew exponentially during the pandemic, when the stock market touched record highs. Talking of pandemic, Bill Gates recently called for ramping up efforts to tackle any future outbreak. So why is Gates worried about a new virus now? Tushar Verma talks to country's top virologist to find the answer.
Till February 28th, the world had lost almost 7 million people to COVID-19 infection, and there were 69,886 active cases. India, on the other hand, had 169 active cases, according to WHO data, and the last time that we saw the cases rising was in June last year. So can we say with certainty that pandemic is behind us and it will not strike again? No one knows for sure. But with hard lessons learned, we can be better prepared for another wave if it strikes. During his recent visit to India, Microsoft co-founder Bill Gates said that the world needs to build more tools and global institutions to tackle any future pandemic. Just a few days before, he had told CNBC that the risks of severe disease from COVID-19 have dramatically reduced, but another pandemic is all but certain. Gates said that the world today is far more prepared to deal with the pandemic, but it is still far away from the required infrastructure and programs. A major flaw that Gates highlighted was the absence of a surveillance system that could not only detect a deadly outbreak, but also prevent it from spreading. But pandemics such as the COVID-19 happen rarely. Then, why is Bill Gates worried about a new virus?
I think one of the things that we need to be aware of is that with climate change, there is a lot more interaction between humans and animals, and particularly wildlife. Now, wildlife and animals, including livestock, contain a number of different kinds of viruses that have the capacity to infect humans. there are at least 25 families of viruses that can potentially cross the species barrier and cause infections in humans. This happens on a regular basis. Every year, there are at least about 5 events where animal viruses cross into humans. But sometimes they cross over and then they begin to spread in the human population. And that's really what he's warning against. The fact that as we increase human animal contact, the chances of the crossover, the chances of human to human transmission will increase.
Gates highlighted that the first 25 weeks of the pandemic destroyed 25 years worth of progress. The pandemic also wreaked havoc on health programs for various different diseases. He said that health systems of many countries are still not back on track. Gates, also the co-chair of the Bill and Melinda Gates Foundation, appreciated how different people came together to build support infrastructure to deal with the pandemic in India. So, is India prepared to deal with another pandemic? If not, what should we do about it?
We must pay attention in India because now India is the most populous country in the world. But having said that, a disease could emerge anywhere and travel around the world in record time. The world is very interconnected, and the world has to be prepared. India has to be prepared. And if you look at it at this point, I don't think India is prepared. I don't think the world is prepared. The first policy that needs to be in place everywhere is improvement of health systems. And health systems includes the ability to detect the rise in infections. Health system includes ability to treat infections, hospital systems, hospital capacity, availability of doctors, nurses, and other technology that goes along with it. All that is needed. And remember, you don't prepare for a war when the war is actually being fought. You prepare for it in peacetime. So whatever time you get now, we must prepare our systems when the next one emerges.
The COVID-19 pandemic vividly highlighted the gaps in the Indian healthcare system. While India was able to manage the worst impact of the pandemic, the focus appears to be drifting. In the latest union budget, the share of healthcare increased by a meager 2.71%. Even worse, the government in India, including both center and states, spends a mere 1.1% of GDP on healthcare. Countries like China, Vietnam, and Sri Lanka spend a much higher share.
Pandemic had also affected the government's plan to ramp up infrastructure in the country. As the restrictions eased, the government went on an overdrive. It raised the capital expenditure by 33% in the last budget. Given the government's infra and capex push over the years, are the stocks of the related industries such as paints, laminates, wood and tile makers a good bet? Nikita Vashisht brings the answer.
The Indian real estate sector grew at a CAGR of 10% from $50 billion in 2008 to $120 billion in 2017. According to estimates of the research and brokerage firm Prabhudas Lilladher, this is likely to grow at a CAGR of 18% and hit $1 trillion by 2030. And a large part of this growth is likely to come from higher capex spending by the government and private players. The budget 2023, for instance, allocated 10 trillion rupees towards capex, higher than the 7.5 trillion rupees allocated for FY23. Affordable housing via Pradhan Mantri Awas Yojana also saw a higher allocation of 79,000 crore rupees for FY24, up from 48,000 crore rupees in FY23. The building materials sector, which includes segments like paints, tiles, plastic pipes, wood panels, etc., commanded a market size of 1.3 trillion rupees in FY22 and could touch 2.7 trillion rupees by FY26, analysts' estimates suggest. However, Anil Rego of Rights Horizons believes the government's push towards affordable housing and infrastructure remains key.
The outlook for the building material sector looks robust, with individual segments anticipated to grow between 8 and 12% for the next 5 years. This is due to urbanization, real estate market recovery, and the increased discretionary expenditure. Residential and commercial real estate organizations have been slowly recuperating since 2021 and are anticipated to expand further. Even though interest rates have risen, they are still below past peak levels, making home loans affordable, and hence the sector is likely to continue to grow.
However, volatile input costs amid renewed geopolitical tensions cloud the near-term outlook. Ronald Sioni of Sharekhan suggests investors remain selective.
Going ahead, we expect as interest rates peak out and stabilize with a possibility of gradual easing, the real estate sector should see healthy pre-sales momentum to continue. We expect piping players to benefit from healthy demand environment led by lower raw material prices, while wood panel and tile companies are expected to see near-term weakness due to weak exports and oversupply led by higher imports. Although considering near-term demand weakness in some sub-segments and current valuations, we remain selective. Our preferred picks in the sector are Century Plyboards, Greenlam Industries, Supreme Industries, and APL Apollo Tubes.
Therefore, the best way to approach this sector would be to look at stocks of companies that have diversified product profiles, healthier balance sheets, and sustainable cash flows. Meanwhile, stock-specific action and global cues will guide investors during the holiday truncated week.
The recent Sebi ban on a bunch of financial influencers once again trained the spotlight on pump and dump schemes. We explain it in the upcoming Decoded segment. On Thursday, the Securities and Exchange Board of India imposed a penalty on Bollywood actor Arshad Wasi, his wife Maria Goretti, and 29 others for their YouTube-run pump and dump operation. Reports have suggested that Wasi made a profit of 29.43 lakh rupees and his wife 37.56 lakh rupees between April 27th and September 30th last year using this operation. Pump and dump is a manipulative scheme where a person tries to increase the price of a share using fake information. The claims are false, misleading, exaggerated, and spread to make personal gains. This is often done by a person who has monetary influence over many people. This is a three-step process in the pump and dump scheme. First, a person buys significant holding in any stock. Next, they make exaggerated claims about the company, encouraging people to pump their money into it and buy more. Lastly, as the stock price goes up, they dump it and pocket the gains. However, as the significant stock volume is dumped, its price falls and other investors lose their money. In the internet age, the propagation of fake information generally occurs via social media platforms or emails. Unsuspecting small investors are also enticed to invest in small and mid-cap stocks using banners and social media messages. In this case, the fake information was being spread using YouTube videos using two channels, The Advisor and MoneyWise. According to Sebi's guidelines, the person who spreads this information is called MMD or a misleading message disseminator. Sebi uses its data warehousing and business intelligence system to identify such scams. It provides pattern recognition algorithms to monitor trading. It then gives data to Sebi on who might be indulging in violating securities laws. Sebi then looks into the stock and seeks clarification from the company. If an unsatisfactory response is received, the regulatory body cracks down on the MMD.
I will achieve, I will fly high. I, I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Jordan Belfort, who was convicted in the early 1990s for indulging in a pump and dump scam, later turned his story into a memoir called The Wolf of Wall Street. That is all for today. For more news, views and analysis, please log on to business-standard.com. For more news, views and updates, subscribe to Business Standard on Google Podcast, Apple Podcast and Spotify. Also follow us on YouTube, Vimeo, Instagram, Twitter, Facebook and LinkedIn.